Hello everyone, and welcome back to Visionomics. We cover every facet of business and investing on this channel. A brand new cryptocurrency network called Terra was taking over the world in late 2021 and early 2022. In contrast to many other currencies, the connected cryptocoins' combined market valuation at their peak was close to $60 billion. Not just meme traders and small-scale investors drove up the price. In attendance were a number of the most well-known figures in institutional cryptocurrencies, including billionaire Michael Novogratz. Terra promised to transform the global financial system by eliminating inefficient middlemen and facilitating seamless cross-national transactions. Even better, they allow individuals to earn 20% interest on their stable coins, which are pegged to the value of the US dollar. As you might expect, this trade quickly revealed itself to be a massive scam, and I haven't seen a better deal since Bernard Madoff Investment Securities. Luna's price fell precipitously from $100 to just 27 cents. Additionally, it appears to be moving towards zero. Many observers now think that the next multi-year crypto meltdown is imminent as a result of the epic breakdown of such a prominent crypto project and the price decrease of Bitcoin since its all-time highs. However, it is claimed that Terra employed a highly advanced and impregnable tokenomic mechanism, ensuring that the UST never deviated noticeably from the USD. Then what went wrong? In this video, we'll take a closer look at what Terra promised to accomplish, the reasons it was doomed to failure from the start, and, more crucially, the reasons why numerous billionaires were scammed. In South Korea, Do Kwon launched Terra with the intention of creating a new financial system that will replace both conventional fiat currency and more seasoned cryptocurrencies, like Bitcoin, in 2019. The system is mostly composed of Terra and Luna, who debuted with their respective currencies and all of their features. Terra is a stablecoin that is intended to look like the Earth and Moon and is linked to a fiat currency, in the case of UST, the US dollar. The purpose of Luna, a support cryptocurrency coin, is to maintain the stability of Terra's value. Because cryptocurrencies may sustain them, they are referred to as Luna and Terra. What is a stablecoin exactly? A stablecoin is a cryptocurrency that is linked to a fiat currency to support the coin's value. You can either purchase a coin for $1 US or freely redeem your coin for that amount. Do Kwon disagreed with the concept that the price could never diverge from $1 for an extended period of time due to the exchange mechanism. In order to back your stablecoin, you must keep a significant quantity of US dollars on hand, which keeps you bound to the established financial system. For complete decentralization, he had a superior approach, and Luna would provide stability for the stablecoin press. Terra Labs made the move, so people transacting in UST would pay a transaction fee to the miners to mine UST. You also must own Luna, which provides the incentive for people to own Luna, thus supporting its price. They sell USD to the market and receive payment in Luna when there is a big demand for UST. Some of this Luna is burned in an effort to lower supply and increase the price. The balance of the Luna is put into a treasury reserve, which will be used to fund fiscal stimulus. Owners of Luna can vote on various initiatives put forth by outside developers if those initiatives aim to boost adoption of Luna and Terra. By this time, the Terra system seemed a little odd. Why would one cryptocurrency be required to sustain another? However, for the time being, it doesn't appear to be a Ponzi scam. Remember that if UST ever falls below $1, they must print $1 worth of Luna to give it to you. Let's say that Luna was trading at 100 per coin, If someone wants to redeem 1 UST, they'll receive $1 worth of Luna or 1. On the other hand, if Luna is trading for 1/100th of a cent, you will need 10,000 Lunas to redeem 1 UST. It goes without saying that if the price of Luna is low, any redemption of UST will result in a lot of inflation, making Luna vulnerable to a Weimar Republic-style government. Given the dangers, why would anyone want to acquire Luna? Hyperinflation. The demand for UST must always rise in order for there to be upward pressure on the price, which is the foundation of this entire house of cards. People will then purchase additional Luna in order to convert it into UST, and this strategy worked until recently. The market valuation progressively climbed from $180 million at the start of 2021 to $18 billion at the peak, as more and more investors expressed a desire to purchase UST. Consequently, why did so many people wish to acquire the UST stablecoin? The Anchor protocol, which they promote as a straightforward method for regular investors to receive immediate consistent payouts in their marketing materials, lies at the heart of this game. They claim that because traditional banks only offer pathetic interest rates of around 0.5%, inflation is eating away at people's money. By allowing the people to finally receive a sizable yield on their laboriously accrued money, they are delivering a fantastic service to the people. Since Anchor holds the bulk of the UST, they earn a yield of about 20% every year. It doesn't sound too horrible that this UST is lent out to borrowers who pledge Luna or other cryptocurrencies as security. It makes logical to want to lend a stable coin and earn a 20% return, just like a bank where some individuals lend money while others borrow it. People are being paid to borrow and lend money, but where does the money originate from? Anchor uses the collateral provided by borrowers, the Luna, and invests it in liquidity pools to generate staking rewards. Theoretically, they may earn enough to pay depositors the 20% interest rate if the staking yields are high enough. Many cryptocurrency traders engaged in various financial engineering methods, where they would lend and borrow UST and Luna while holding positions in UST that were incredibly leveraged. They made 20 yield on the entire amount of money they deposited in the Anchor. But in order to obtain a significantly greater income on their initial investment, they heavily leveraged. They would need to possess a sizable quantity of Luna to maintain this. This only functions as long as Luna's price is rising or at least stable. Otherwise, sellers will be compelled to liquidate their inventory, increasing the coin's selling pressure. Do Kwon and the other senior management team at Luna knew that this was a big risk if people lose confidence in the system, and the price goes down. Anchor won't have enough money to pay the 20% interest. As soon as they stop making these interest payments, there will no longer be any reason for anyone to put their UST in Anchor. They agreed to create a war chest to support prices in the event of a panic, because if they withdrew their money or sold their UST, the entire system would collapse. It is comparable to the way a central bank accumulates foreign currency reserves to maintain its own currency. In order to accomplish this, they printed more Luna, which raised a $1 billion emergency reserve. They used this money to buy Bitcoin, but who would give them $1 billion to the system that looks like a Ponzi scheme? As it turns out, there are some institutional investors who are unsophisticated enough to buy into such a crazy system. To Michael Novogratz. He is a multi-billionaire investor who formerly worked as a partner at Goldman Sachs and founded Fortress Investments, a hedge fund. It ultimately fell short. He then focused on cryptocurrency and founded Galaxy Digital, a cryptocurrency business. We don't know the precise amount that Michael Novogratz or Galaxy Digital put in Luna, but it was presumably a considerable sum considering that he had a conspicuous arm tattoo of the word Luna. Referring to the cryptocurrency, another large trading fund called Jump Crypto led the $1 billion funding round, which Terra used to make their emergency Bitcoin fund, called Jump Crypto. As a result of the Fed's rate hikes, which started to produce a broad risk-off attitude for both equities and crypto, the crypto market began to plummet around the beginning of May. To lower the risk in their portfolios and prevent margin calls, cryptocurrency traders began to liquidate their positions in UST and Luna. Investors began exchanging their USD for Luna coins at the same time as other investors were already selling their Luna as the price fell, creating a death spiral. The inflationary effects of the redemptions drove the price even down. To redeem each UST at its $1 value, you would need hundreds, thousands, and finally tens of thousands of Luna. UST now sits at 20%, at least theoretically, having fallen below its $1 pegs at this point. This shouldn't be conceivable. Arbitrages should be willing to purchase UST for 20 cents and profit without taking any risks by selling it for $1 of Luna. Terra is now facing the same problem as Weimar Germany after World War I. They owed a lot of money to foreign creditors, which they didn't have enough money to pay, so he started printing trillions of marks, which they exchanged for foreign currencies to pay the foreign bonds. The currency brokers refused to work with them. Even if they receive 1 billion German marks for every dollar, by the time they try to spend it, the mark's value has drastically decreased. You wouldn't give 1 unit of actual money even for 1 billion marks, because it would already be worthless. UST is experiencing the same issue. It goes without saying that everyone who invested in Luna coins lost everything. To make matters worse, Jump Crypto just experienced another catastrophe this past February when they lost $320 million, making each coin worth just a minuscule fraction of a penny. When a different cryptocurrency project they were working on, dubbed Wormhole, was compromised following 2 disastrous losses in just 6 months. The road for elite cryptocurrency might be coming to an end. These institutional investors seem to have done very little to no due diligence before investing in Luna, even beyond the plainly unsustainable nature of the Terra system. Do Kwon's track record alone should have been sufficient to rule out any investment. Prior to Terra, he developed Base Cash, an algorithmic stablecoin that worked quite similarly to UST. You won't likely be shocked to learn that it was a total failure as well and currently trades for 0.74 cents each. At the end of the day, Terra was a Ponzi scam that was practically certain to implode sooner rather than later. It depended on more and more individuals investing in the coin after promising investors 20% risk-free returns. To make it more complex, they obscured it by moving the money around numerous different coins and protocols. When all was said and done, investors had collectively lost around $60 billion in paper value. Coincidentally, this amount is quite close to the $65 billion lost by investors in the securities of Bernard Madoff. Okay guys, that concludes this video. What are your thoughts about Luna? Tell us in the comments section below if you think it ever had a chance to work or if it was always a fraud. And that, Visionomics, I'm out.